What's a false assumption about emerging managers or GP investing that you want more LPs to unlearn?
I think it's perfectly okay for a GP to have one or two funds and not continue to go on and be forced to oh my gosh, I gotta find a second partner, or I need a succession plan if I'm an older GP. Strategies change, circumstances change, the markets change. I think it's absolutely something from an LP mindset. You should be thinking about this as I have to invest in the next big franchise. So I think that's something that I would encourage LPs in this category.
Hey everyone, welcome back to the Ignite podcast. Today we're thrilled to have Eric Wu on the mic. He's the co-founder and CEO of Revere VC, a platform reinventing how allocators evaluate and manage emerging funds. Very interesting for us. Eric blends deep investing chops with product sensibility. He's a CFA. All three levels?
All three levels, yeah, absolutely.
All three levels, Eric? That's
Yeah.
amazing. Engineer, former head of institutional capital at AngelList, and longtime advocate for data transparency and infrastructure in private markets. Let's get going. Thanks for coming on.
Appreciate it, Brian. Glad to be here and excited to share some thoughts and wisdom, especially where we are in the venture markets today, definitely going through its own evolution.
Yeah. Well, I'd like to start at the beginning, kind of get your backstory. What's your origin story?
Well, it starts with trying to try my hand as an engineer. So went through 4 grueling years of engineering school at Berkeley, figured out very quickly I didn't have the disposition to be an engineer. Yeah, absolutely. And that was really, for me, a formative moment because I wanted to transition into the world of finance. And, speaking of CFA, that was my escape hatch from engineering was, first job out of school. People were going out and partying on weekends and weekdays, and I was studying for the CFA exam, but it was definitely something very worthwhile because it got my foot in the door on the finance route. So that was really kind of chapter one for me was, figuring out, I had some technical sensibility, but really wanted to pursue a career in finance. CFA was a natural way to do that without, essentially going through business school. And it's kind of shocking, but that was 2004 when I completed the CFA exam. So I've been kind of 20 years through that experience. And then obviously a couple of additional chapters, moving into venture, even experienced the global financial crisis in a very unique and interesting way. But would love to unpack all this stuff as we get through this conversation.
Yeah, it's fascinating. I kind of used, I just did the level 1 and I kind of used it as a way to get my first analyst job on Wall Street. I was finding I wasn't getting call backs. This is 2005 or 6, roughly the same time frame. I was like, okay, I'll just do the CFA. And that got me the job. And then I quickly realized I didn't want to do the job that I got. Anybody who's listened to this podcast knows this story, but I won't repeat it. But so what did you do next? What was your first job post CFA?
First job working for an insurance company in risk management. And for those of the audience who are old enough to remember this, I was actually pricing CDOs. And this was during 2005 to 2007. For the insurance company, they had a financial guarantee division that was pricing a lot of the CDOs that were going to market. I was running the models, pricing the risk. And then at the same time, we were doing some interesting things with hedging in the synthetic indexes on basically asset-backed securities. And, you saw some interesting names like, Goldman Sachs was short the market, and you had Lehman Brothers, Bear Stearns long the market from a hedging basis. And so if you fast forward through that period, obviously 2007, 2008, we saw a lot of carnage in structured finance CDO markets that led to the global financial crisis. So that was my first front row seat experience in terms of what financial engineering can do to the markets. And then that was where I said, again, what's my next escape hatch, out of this world of structured finance that led me to venture capital and startup life.
What did that transition look like? You're working doing this, and then kind of what happened next?
So I ended up working as search engine marketing. So this is circa 2008, 2009. So if you remember search engines like Google and Yahoo and MSN, they all had, basically, keywords, paid keywords, and people were doing ads on keywords. And this was the new innovative way to do online marketing. And then someone behind the scenes at all these companies, or you would hire essentially a big agency that would run complex Excel models to figure out where there's optimization of pricing. So if if I bid 5 cents more for this keyword, now my placement is number 3 versus number 5. And we know conversion ratios on the top 3 are 20% higher. So it was an interesting direct correlation or kind of translation of what I had been doing on the modeling side in terms of pricing models and pricing risk, but applying it into a new category and working within, at that stage, this company was called Account Now. They were a Series B PAC company. So it was kind of coming in at a mid-stage startup company. Fascinating experience, but that was really the first entrepreneurial experience for me that really started to uncover, sort of this ethos of, what it means to like be building something for a fast growing company. So did that for about a year. And then I got called by a good friend that was running a venture capital fund of funds. And this was Northgate Capital. And they were hiring their first analyst. And so, as is typical, especially being based here in Silicon Valley, the network of venture capitals, just word of mouth, somebody calls you up and says, hey, come join and help us out, and we'll see where this goes. And that was my first foray into venture capital. That was 2009. So went through a few different iterations, different chapters from that 5-year period, but it was all kind of identity crisis for me. And here we are kind of 15 years later from that first venture experience, and I'm still in it.
Yeah, I mean, once you get sucked in, it's hard to imagine doing anything else. That's personally how I feel. I'm not sure how you feel, but once you kind of get in, it's kind of intoxicating, right? Investing in startups and just being in the industry and right at the tip of the spear of innovation and capital. Looks like you had 3 main arcs here before Revere, Northgate, Top Tier, and AngelList. Maybe you can kind of walk us through each of those experiences and what you kind of took away and how it led to the other.
Yeah, so the Northgate experience was actually really interesting because the first job function was actually in the back office. So I was working with auditors. They were, Northgate at the time had quite a sizable co-investment portfolio in addition to their venture capital fund of funds. And at the time, a lot of the regulations were saying, well, look, you've got to mark to market your direct holdings. You got to run some option pricing models and come up with something that kind of felt scientific, which was almost impossible, right, at that time. So my first experience was actually understanding, valuations, running models again to price the direct holdings and that. And then, a lot of this was also things like, fund formation. So they were going to market, helping them with a lot of the LPA type of stuff. So first year and a half at Northgate was back office works, learning sort of the mechanism, the mechanics of how to run a venture fund of funds. And then slowly I started to get familiar with the portfolios, started to join some of the partner calls and meetings, especially as managers would be coming through and doing their pitches, and started taking notes and sort of seeing and understanding, appreciating. And again, everything at the time was much more art and relationships than running, option pricing models and cash flow models to actually evaluate the risk. So very, very a new muscle for me. But what I found especially intriguing was at that time, the cottage industry of venture was now having this interesting offshoot of seed and micro VCs. You had people like Mike Maples at Floodgate and Steve Anderson at Baseline. And of course, kind of at that time, Emergence was coming onto the scene and sort of touting this concept of, SaaS, software investing, which sounded so foreign at the time. And that preview of what the job function of a solo GP, someone who had an angel track record or came from the operating background, coming into the industry of venture capital and saying, you know what, I can uniquely help founders beyond just the capital. And not only that, I wanted to help founders in that 0 to 1 period of their company formation. And that really was the birth of seed investing. So it really became something that was like, Ron Conway and his band of angel investors to now people now starting funds and getting institutional LP capital. So that Northgate experience for me was the first taste of this. And really, this is very early days. And then the transition from Northgate to Top Tier was partly because I had left Northgate and had started to conceptualize my own fund of funds concept within micro VC. And again, speaks to how excited and how passionate I was about that space. So paints a picture. I was quite naive about sort of raising a fund of funds for something that was such a new concept at the time. But I was very fortunate to connect with the people at Top Tier Capital who were just getting their what they call their alpha program off the ground, investing in funds that were kind of that sub $150 million fund target. And so during that period, kind of 2015 to 2018, really had the privilege of, helping and managing a pretty sizable pool of capital. I think we had done about 23 investments in the space of the emerging manager category. And then, of course, there's, several hundred managers along the way that you meet and you start to sift through, start to build your own pattern recognition. But most critically for me, I think it was just so many personal relationships. And that's the one thing that I think continues today is if you look at the entire trajectory of venture dating back to the 60s and 70s, is these are not only business partners, right, in terms of LPs investing in GPs, but these are our personal relationships, and the trust and credibility that comes with that is such a critical and important part of that underwriting process. So I'll pause there because that kind of spans the
Yeah.
institutional part of my career. And then I had sort of my own kind of midlife crisis or mid-career crisis when I started to move over to AngelList. But yeah, happy to answer any questions on the institutional side.
Yeah, no, that's fascinating. For some, an emerging manager like myself and probably plenty of people listening, the question always is like, how do you break through and get institutional capital as an emerging manager? And you've looked at hundreds, if not thousands of these emerging managers. What kind of heuristics or, muscle memory did you build up on evaluating these emerging GPs?
Yeah, and there's I like to kind of compartmentalize these into different waves, right? So the early wave, like I said, the baseline, the floodgates, that was very much just their scarcity to the number of funds and managers that were operating in the space. So you truly did have the ability to build sort of very long lasting relationships and really get kind of deep understanding of the fabric of how people were thinking. The Northgate and Top Tier experience was now, I call it sort of the institutionalization, right? The legitimacy of a fund, someone like Ulas from Streamline Ventures, right, who came from GlobalSpan, had an incredible angel track record raising his first fund. That track record translating into running and building his own franchise was institutional in nature, not only because of the pedigree and track record of these individuals, but also the validation that LPs, institutional LPs, were saying, you know what, this is an important part of that venture allocation in our portfolio. And that kind of was the spark that led to just more and more people coming into the market. So you asked about heuristics. It used to be just good old perseverance, blood, sweat, and tears, seeing people show up. Honestly, I remember some managers would just, every time they came through San Francisco, they call me up and grab coffee, give me the update. And, over the course of a couple of years, you start to get to know people, and that starts to actually help with the advocacy of, me taking managers to the investment committee. And I think today, or sort of as you move from, 2018, 2019 vintages into 2020, 2021, 22, obviously COVID was kind of an important ingredient in terms of changing how we've interacted in that process of diligence. But that concept of, what's the special sauce? What's your differentiation? What's your specialization? I mean, you've heard these terms thrown around so frequently over the last 5 years. It really was an era of specialization, right? Not just in terms of the category, but looking at where are you adding value, right? Both economic value to the portfolio companies that you're investing, but sort of the value add as a manager to your portfolio companies. And that honestly was something not completely conceptualized, 10 years ago, right? It was just like, hey, be good stewards of capital, be a good board member, help companies when they had problems and asked. But now all of a sudden, every single emerging manager, and so yourself included, has a playbook or multiple playbooks, right? How do we get that first customer for our portfolio companies? How do we, help them through the process of raising their next round and positioning that and actually going out on their behalf and talking to follow-on investors? I mean, everything has become around sort of the specialized toolkit that you provide. And in that vein, it just becomes increasingly harder to say, okay, well, what's unique and different about your toolkit? versus someone else's, right? So absent of the benefit of 5, 6 years of your company's growing, raising follow-on rounds and exiting, it's a sea of people who are all helpful. Definitely it's adding a lot of value, but for LPs, it's tremendous confusion.
Yeah, it's kind of hard to sift through. And we'll circle back on these questions as we continue the conversation. But I'd love to hear about this mid-career crisis and what happened there.
Part of it was thinking through what I felt was sort of diminishing returns when you work in large organizations that, to their credit, right, all funded funds and asset managers, they grow assets and they become more of a financial access product than the artisanal nature of delivering alpha on returns and just being thought leaders. So as Top Tier was becoming more successful, growing, expanding sort of the LP footprint, just felt like sort of this category of emerging managers within the portfolio was, I wouldn't say it's an afterthought, but just becomes sort of a smaller part of the forward kind of strategic vision. So I had some friends at AngelList at the time. And so for your audience, those that are familiar with AngelList, obviously, Brian, you've been active on the AngelList platform. It had moved from something where syndicate leads were bringing their best deals to now syndicate leads saying, you know what, this track record that I built and the LPs that I've met on the platform, this was a natural avenue for me to start my own fund. Nano-funds, small funds, $5 million, $10 million to get up and running. And so AngelList was faced with an increasing supply of syndicate leads. They're saying, you know what, I want to try this and do this full time. So I was brought in, I was recruited
That's how
in
I got
to
started.
really, yeah,
Syndicate lead on
absolutely.
AngelList.
Yeah,
First couple of years, just syndicating deals. What year was
100%.
this for you?
And yeah, this was 2018. So that was a time where a lot of the syndicate leads were now starting funds. And increasingly, AngelList had a stronger footprint in the family office LP world. So if you look at both sides of that, you had increasingly sophisticated LPs, family offices, and some, RIAs. And then you had syndicate leads now starting funds. And that just naturally meant that there was a little bit more of an institutional platform, right? So my job, my goal, and this is what I found so fascinating, is like, Eric, can you come and understand, obviously, my background, I knew the dynamics of GPs and LPs, but can you build a product experience for matching syndicate leads who are now doing deals and doing funds with family offices that, by nature of them coming on AngelList, I call it sort of like participation sport. They looked at venture as part of their portfolio, not for, people have used this term. It's not like they were gambling, but they wanted to be involved. They wanted to meet you and understand which interesting companies that you're investing in so they can kind of tell their friends that they're doing this thing called venture capital.
It's interesting you mentioned that.
Yeah.
It's with family offices, it seems to almost sometimes be a signaling mechanism to their other family offices they know. It's like, oh yeah, I was in a fund that was in Stripe, stuff like that.
Well, venture, and I think this is still true today, honestly. It's the one asset class that gives you a preview of this future that you can't buy that exposure anywhere else. I mean, yeah, you can say someone like Google or Meta or X has AI exposure, but it's that versus, like, imagine you being an early investor indirectly in OpenAI or Anthropic or Palantir. Venture is the only asset class where you can get that exposure way earlier in the life cycle. So that's something, especially with family offices, like I said, they look at venture as just a way that's uncorrelated to the rest of their portfolio. So, but yeah, just to finish the thought on AngelList, I think it was a wildly successful experiment of them trying to formalize this. And obviously, SPVs, being able to create SPVs on demand and all the infrastructure that they built to productize the entire stack of how you run a venture fund has been amazing. So and then that kind of took us into COVID, and obviously COVID changed a lot of things, notwithstanding a lot of capital just simply dried up in the seed category.
And so how long were you there? What are you kind of looking back? What are you proud of what you built at AngelList? What were some of the challenges that you faced, kind of connecting these family offices to emerging managers, and how'd that whole experience go?
So I was there for a couple of years. And again, this was like kind of right up into to COVID. So that was kind of a natural jumping off point. Some of the interesting things I learned is like you actually can, I call productize, sort of this matching algorithm. And a lot of it was taking all the things that I remember when I was doing like reference calls with other LPs and saying, oh, like, Eric, what do you like about this fund? And I started actually developing my own internal scorecard for assessing fund managers. So one of the fascinating things that happened through these series of conversations is like I just came up with something that looked like an underwriting model and started to develop ways to quantify that, right, through numbers and not just anecdotes. Some of the interesting challenges is it was a super hard thing to scale. And I'll give you a very specific example. So if let's say, Brian, I matched you with a family office, put you guys together, say, hey, you got to meet Brian. He's exactly the type of fund you're looking for. That family office or maybe that ultra high net worth is like, okay, awesome. I made the investment, but it's like, I do one a year, right? So the scalability of, you have this amazing experience, you build a network, a community, there's network effects happening, but the scale is so hard, right? When you're looking at sort of, I call retail plus, because just people didn't have, unlimited budgets. And once they did one, they're like, okay, 2 or 3 years later, they'll kind of be back in market. And then do they continue to re-up and venture? So scalability at the time there was always kind of a ceiling to that, right? And that was what was, I think, challenging for a high growth company like AngelList that wanted to think in the terms of like, how do we get 1,000 funds? How do we get capital for 1,000 funds, right? So, but I think, today some of these friction points are different, right? You have like marketplace platforms like iCapital and Opto that have sort of created the fund of funds, venture fund of funds as a financial product. So distribution wise, it's become a lot easier to pull in capital into smaller funds. Won't get too far ahead in the story, but I think if anything, the takeaway from this kind of outline is each of these phases in the cycles in the venture evolution as it relates to emerging fund managers is both a construct of what's the macro in terms of capital flows, and then also what is the true kind of value proposition of a GP presenting themselves to the LP market. I think every 3 to 5 years it changes, and the best managers, the ones that have continued to raise more and more funds, they adapt to that. And the story changes, and it's absolutely okay that the story changes. And I would argue if your story's not changing and adapting, you are falling behind.
That's fascinating. I like that. You have to adapt to the times, right? Because times do change and AI is changing everything right now, obviously. But what are some truisms or things that never change about evaluating GPs and their funds?
Yeah, this is an easy one. And I say this is easy now because now having been a founder for 5 years, the universal truth or sort of the first principles of this is really the founder VC dynamic. It's not fungible, right? You can't, this concept, who's the first call? I think about my cap table, I can clearly say these are the 2 or 3 VCs that I always call when I run into problems. So that's the universal truth is the best fund managers, the best VCs have a very unique and privileged relationship with their portfolio founders.
Yeah, I love that. So as a LP, if you're listening, the lesson there is try to back channel with some of the founders and talk to them directly and say, hey, how is this GP on your cap table? Was that worth it taking that check from that GP or not? And are they your first, second, or third call to get help? And how helpful have they been per like dollar invested?
Exactly.
Is another way of measuring that too, right?
Yeah.
Right. I got $1 million check sitting on the cap table and I don't feel like I can call that GP or don't want to. That's oof. Versus, maybe I accepted a smaller check from an emerging manager that works really hard and I can call that person, and that's a differentiator.
Well, and Brian, the spectrum of how you can measure that referenceability is expanded today, right? And I mentioned the underwriting model that I started to think through at AngelList, and we've applied a lot of this to what Revere built. It's the first customer, right? So being able to pull the portfolio and say, like, how did you help influence or close that, pilot customer for your portfolio companies? How did you help make that, vet that first sales hire for that portfolio company that led to then the subsequent revenue growth? So that the data set from which we can measure this concept of like that founder VC relationship and how they're adding value is so much more varied and complex today. I just think what is challenging, especially for LPs, is there's no kind of standardized contract of this. It's not like you throw this in a model. And most of the times you're just asking this in like a reference call. And so how do you codify? How do you structure that type of information? It's tremendously challenging.
So what was the aha moment for Revere? Did you say at some point like, hey, this is missing in the industry and somebody's got to build it? Tell us kind of the backstory.
Yeah, very similar to along those lines. I think it was partly I had enough confidence and conviction to really start something on my own. Again, I had kind of 10 years earlier from today, I'd try to start my own fund of funds, but doing a fund of funds as a startup versus doing a true startup where you have an idea. And at the time, it was myself and my co-founder, Chris, were in the kind of the onset of COVID, we're, staring at each other in a room and saying like, what can we truly build that's disruptive in the next 5 to 10 years? And do we want to do that? Right. It's a lot of, life and career risk. But we just felt so strongly about this idea that we were coming into a new cycle in the venture market. And then secondly, we were so well equipped as individuals and our collective GP and LP network to say, you know what, like we can do this, even if it's in the depths of COVID. So that was less an aha moment, but just, I would say, a little bit of navel gazing and saying, you know what, no one else is doing this. And as we all know, like kind of in the depths of the cycle, that's usually where the next great kind of iconic companies are started.
And so what is the idea? What does Revere do? What problem are you solving?
So when we originally started, it was just purely, let's just bring data and transparency to the problem because it still is today. Hard to get accurate data, hard to get enough data, hard to trust the data source. So when we first started, the first product was a lot of that early blueprint of a rating system for emerging managers. And it was essentially the way I would have written an investment memo to evaluate, your fund. And I had 20 different subcategories, everything ranging from, operating experience, track record, how do you manage the portfolio, like the investment operations. So we had 20 different categories and we went off and essentially took the first 50 fund managers. These were basically our friends who God bless them, offer to be guinea pigs to get scored and rated. And we asked them a series of questions and we started to put together the distribution of answers. And then from the distribution of answers, we'd say, you know what, like these answers here really evoke something that I would consider like, above average or best in class. And we took that rubric and we started to put a score behind that. And then we went out to the market formally and said, you know what, we're gonna be so bold as to say, like, at the time we called it kind of the Morningstar report for venture capital. It's like we would go out there and solicit GPs to come and again share their data room, go through an interview. We would completely open up like our draft of the investment memo because we understand the nature of this dynamic as like we needed to give something back to the GP, help them understand, hey, strengths and weaknesses. And GPs were not paying, right? We wanted to avoid that conflict. LPs were paying us for the diligence reports, paying us to actually go through and buy the reports. And so it was very well
Did the
aligned.
GP have an opportunity to like go, oh, I wasn't clear. You rated me a 3 out of 5 on that thing, but like, let me like try to improve that by giving you another response here. Let me give you more detail here so I can get a 4 out of 5 at least on that. Like how's that kind of,
absolutely.
how's that tension work? Yeah.
Yeah, I think when we were, if you look at kind of the second phase of the underwriting model post, guinea pig phase, we started having enough data to either validate or refute that. So if you came back and say, hey, like, why was I rated a 3 out of 5? I would be able to say, well, look, I've got, all these answers and like you clearly fit sort of in this slice of like a 3 out of 5. So one way to respond is like, and I'll give you the example of like, the value add, like we actually start to measure or ask for people to give us their tracking spreadsheets of how much revenue they were influencing or generating on behalf of their portfolio companies. And so what was fascinating is like, so the first time someone did that and then shared that with us, it says, all right, absolutely, we're bumping you up. Now, again, we're not an audit firm. It's not like we're calling founders and validating it, but just the mere tracking and thought process of like, hey, this is important for us to do internally as a measurement of how we are adding value, that started to influence the scores. So what you have happened over time.
I'm thinking about this at Team Ignite, like how I would game the system here, as it were, to like try to get higher scores. Because for us, it's all about the network, and it's not about me, the GP, helping the founder, right? It's about the network helping the founder, right? And trying to suss out the details of that is really difficult because it's like it's thousands of little interactions that happen in the network. that kind of have an emergent quality of value. And it would be really hard I think in Revere's system to kind of paint that picture in a proper way of like, oh yeah, here's exactly how much revenue we influenced or how many people we help hire, how many dollars we help fundraise. We have anecdotes like founders are like, hey, you single-handedly like filled our round, but those are just kind of anecdotes.
Yeah, and it's a starting point. But I think that was where we felt that just simply coming up with a scoring system and then having that scoring system make its way out into the GP community of saying, oh, like, and then, again, we shared the rubric so people can understand where they're coming from. But what you just said was absolutely critical, because even with the anecdotes, we can start to create the buckets of like, hey, just the fact that you are measuring and doing something, whereas there's a lot of people who aren't doing anything in that category.
Yeah.
Now,
And they
other
have no
fun,
evidence, right? It's like, oh, we add a
yeah,
ton of value. Great. Show us how you add value. Like, I add value. Trust me.
exactly, right. And this is like, again, from the LP side speaking, we hear this all the time, but then as you drill a couple layers deeper, you just want to see that there's substance there. So that by itself at least helps with the distribution. So all this is, if you look at kind of just math and statistics, like you absolutely, to be intellectually honest, you can't have every manager be like way on the upper end of the scoring system, right? That's what we had to refine over time and we did this
Yeah.
for
You
two
almost have to
years.
enforce like a natural distribution here around the mean, right?
Correct.
But there
And
is a
that's
power law
where,
at play too, right? I would imagine there's a power law in GPs and funds as there is in the underlying asset class. Like some
well,
are just
and
like way better, right?
absolutely. But you need enough data points, right? So we had gone through about 200 fully vetted, rated fund managers, and we had another, 250 that had, shared a lot of information, but we haven't like kind of did the full report. And so we were just about to kind of unlock, and on the back end, we were looking at all the distributions, and we were kind of asking ourselves that question, right? Like, are we seeing enough of a distribution? And then are we starting to see where the outliers start to happen? And we were starting to see this. Obviously, SVB, Silicon Valley Bank crisis kind of changed the dynamics of just like how much capital was flowing into the ecosystem from the LP side that essentially made it very difficult from just a pure monetization standpoint. But we continue, and up to today, like we still continue to capture the data. We are kind of actively commercializing the reports now, not to jump too far ahead, but we do want to pick that up again, because I think it's such an important forcing function in terms of easing the friction in the market. And that problem has only gotten worse today over the last couple
Yeah,
of
it's
years.
interesting, and I'd love. I don't know if you have me rated on your system, but maybe after the call at some point we can rate Team Ignite. One thing I recently did for my founders, or all the the 50, 60 pitches I get a day, is I kind of open sourced my rubric. I've written an article on it and I've kind of refined it over time many times. Like, here's what good, better, and best looks like, and kind of what I care about. But I went one step further recently, which is I kind of put it behind a GPT wrapper. So you could upload all your files, your resume, your LinkedIn profiles, all your data, your pitch deck, your financials, and I'll literally give you the report back that I would look at with AI to evaluate whether or not I should meet you. And so now founders can go out there and literally see what I would see before I see it, so that they can iterate on it and maybe put their best foot forward. Have you thought about how you do that in this industry, like with GPs?
Well, I think this is where AI is going to be game changing for us, right? So when we were doing these reports, it was all humans, myself and a team of analysts, kind of doing the writing, the evaluation. Now, like you literally can throw a data room into GPT, and you can have it kind of produce reports, and then even in a chat interface, kind of drill down the velocity in which you can take a large number of data points and data files and be able to kind of start to summarize it, and then even from a prompting and training perspective say, hey, look, here's my rubric, and by the way, I'm going to feed all these historical scores and reports to fine tune it. I mean, this is the experiment that we're working on internally. It's going to start to look very much like what you said, like where somebody almost can kind of self-assess, and there will be a report to say, like, here's like your, imagine a heat map, and like, here's your strengths and weaknesses. And then if that can kind of be, and really where we're going with this is we want this to kind of look a little bit like kind of the Carfax report, right? We want every fund manager in the market to have the Revere report as just purely we've shared our data, the data has been processed, and there's a level of seriousness in terms of how we are approaching raising this fund. And then that becomes an engagement point because if Revere's well respected and trusted, LPs can look at that report as a screening tool. And then what you do is you eliminate all those kind of cold calls, LinkedIn intros, and you give the LPs a tool from a screening perspective. Say, you know what, if I put in these are the categories I'm interested in, here are the attributes of fund managers I like and I don't like. Here's the 5 reports that spit out, say, here are your matches. And then go talk to those 5 funds and spend time with those GPs. That's how you actually eliminate a lot of the friction, right? Not only just from the time perspective, but if the match is better, the likelihood of capital formation is going to be a lot higher.
Yeah, and I think what you're describing is the tension between AI data automation versus human judgment. How do you guys balance that in your platform?
Yeah, it's a really interesting question because we do have our own kind of AI portfolio management solutions that kind of post Revere rating reports. We ended up kind of pivoting more toward the SaaS side where we build portfolio management software. And portfolio management, monitoring and reporting, absolutely. There's AI tools now that can scrape information, very accurate, produce summaries, and then give you dynamic dashboards. We ourselves are using AI, and then we're delivering that to our clients through kind of a SaaS platform for monitoring their portfolio. But the slippery slope here from a reporting standpoint or an operations back office standpoint, AI is like amazing. It's going to, revolutionize private markets in terms of that operating function. The investment function, on the other hand, now again, put aside things like private credit or private equity where you have enough real data points to actually feed this into an AI model. Venture, for the most part, is still sizing up the individual, right? What are their motivations? What is their capacity? Like, if I invest in fund 1, are they going to be around for fund 2 and fund 3? There's a lot of humanistic things that are very hard to structure and capture. Now, I do have a thesis on this. And this is something that we're going to be working on next year. And the AI, I believe, is actually the future of AI as it relates to capital formation in venture emerging fund managers, is capturing unstructured data. So imagine how many networking events you go to, GPLP conferences, coffee meetings. Imagine if you were to take that quantum of conversations with those LPs and take that unstructured data and somehow structure it as sort of a score, like a GP score and LP score, and then use that as a matching algorithm. So that's the intellectual exercise that we're going to be working on, is like, how can we measure unstructured interactions in combination with the structured interactions to come up with a better matching algorithm.
Yeah, it's a fascinating thing, and AI is impacting startups. I'm seeing startups grow faster than ever for sure. But it's also, I think it's gonna impact venture at some point. I mean, it's definitely impacted us at Team Ignite. I mean, I'm a solo GP with the team Ignite behind us. That's the large network. But basically, the way Team Ignite runs is a bunch of AI contractors, automation software, and myself. And so, if you think about it, if you follow that thread to its logical through line in the future, do you even need like a 2% annual management fee for 10 years to run capital anymore? Because I can put in some contractor with an MBA in Argentina for, I don't know, 15, 20 bucks an hour, processing all my due diligence with AI. And this is literally how we're doing it right now. I don't have to hire some MBA in the Bay Area or some $200,000-$300,000 a year person. I can hire a $20,000 a year person, equip them with 150 IQ AI to evaluate, deal screen, dump the due diligence docs. And I'm thinking about this. Would it be compelling to LPs to kind of tell that story and say, hey, here's how we're different at Team Ignite. We leverage the network, but we also leverage AI, software and automation, and contractors to go faster and deeper. We don't need to charge 2%, by the way. Maybe we charge 1.5% or 1%, and maybe we make it up on carry. We charge a 25% carry instead of a 20, or we just keep it like 1 and 20. Do you think that story would resonate with LPs? They'd be like, wow, that's interesting and differentiated. Maybe you're really not adding value there at all because you don't have lots of really senior people for the startups to talk to.
It's an interesting question because I think just the use of AI tools within fund managers, that's already happening today. And I would argue it's kind of table stakes to have some tooling internally that brings some sort of efficiency to just, how you manage the pipeline and then how you're processing it. So I think LPs already have that expectation that all GPs in some shape or form, right, whether it's buy or build, are using and leveraging these tools. To the extent that becomes differentiation, or if you're now saying like that helps me potentially lower the management fee, that makes me attractive to an LP because, as we know, a lot of LPs are just sensitive to paying management fee. I don't think it's a primary decision point, because I also do recognize that the vast majority of LPs who are investing in this category of smaller funds, there's already enough confluence of materials to say like they outperform, and they're small in nature, and you need the management fees, right? Just to even pay a salary for a solo GP living in New York or
I mean,
LA or
yeah, if
San
you're running a $10
Francisco.
million
Yeah,
fund, you need the two. Yeah. Yeah. You need the
percent.
2% if
Yeah,
you have a 10 or $15 million fund. I'm talking about,
yeah.
you get up to $100 million fund. How do larger funds do it? I heard they kind of, they'll taper it after the investment period. They'll go 2 for 3 or 4 years, and then they'll go 1 for the rest.
Yeah, I think there's ways to get creative, but again, I always just come back to this. Like if an LP's, outside of you, like being in a university endowment, investing in a big mega fund, like negotiating on fees is missing the point, right? You're looking for alpha generation, and you're expecting an underwriting 5 to 10x at a fund level for this category. And so the fees should be diminished, right? I mean, if anything, you would be arguing about the carry. But again, that's why you're in this business as a GP. But to bring it back home, I think AI tools for GPs, table stakes today, LPs are expecting it. Where it can drive kind of LP interest, I think, is actually going back to that. I use that word transparency. So imagine if you were able to now share your diligence with LPs, right? So as I mentioned before, a lot of LPs who are investing in this space are strategically curious about the companies you're investing in. So if the AI playbook or the AI tooling allows you to surface more interesting information, right? Again, not sensitive information to your LPs, then that's fascinating. So again, going back to your example, Brian, like you have your, people can upload the data room and a little report spits out. Like, so imagine your LPs having access to those reports, right? Both the reports of the companies that you invested in, and maybe even the ones that you didn't invest in, because there's a lot of LPs that still want to see that stuff. It's not a fit for you as a fund, but maybe a category where that's where they're interested in. So even having that kind of deal flow database and being able to interact with it through a chat interface or look at reports, I would argue that's tremendously differentiated for LPs from a transparency level.
Yeah, I got to be careful. Some founders don't like that, right?
Of course, of course, of course. Yeah, it's not like you would want to publish financials, but just even be able to just like have these summaries. I mean, again, we all know and use PitchBook, right? So when LPs have access to PitchBook, so I'm not saying you have to go and like recreate PitchBook, but it's just going back to the ethos of like why would an LP invest in you? It's like, just the concept of transparency. Here's one way that additional transparency is manifesting itself. Again, a lot of fund managers are also now doing follow-on co-investment opportunities, whether it's SPVs, follow-on vehicles. But this is another important component of what you can offer with LPs, right? They don't have the time, they don't have the access to deal flow. And so if you now have, as part of your platform, right, the ability for LPs to invest directly in some of these high growth companies, that's another lever to build an engagement model with the LPs.
So what are you excited about right now for Revere over the next year or two?
So I think it's probably by the time you guys get through the editing of this, it'll be public information, but we've merged with another company. The company's called Velvet. They are AI native tools for GPs to help manage the pipeline, all the due diligence, essentially the analyst in the box. In addition, combining our forces on the GP and LP networking side, we're going to be launching sort of our event series. We call it the underground, right? So it's just bring back the ethos of getting GPs and LPs together in person, which I think is really, I call it, old is new again, right? And old in this space where people are struggling to raise money from LPs is you just got to find the right curation opportunities and bring people together under the banner of Revere and Velvet. So I'm really excited about that combination and building out sort of the network effects there. And of course, all this is underpinning, how do we start to use data to use AI to monetize all the data that we've been tracking on both sides.
Yeah, that's exciting. Well, I'd love to get a demo of Velvet because I build a lot of my own tooling because I built a lot of AI and automation over the years, and Replit makes it pretty easy, but it's something that's always at the last thing I do. It's like,
Hmm.
okay, now I need to build some AI and automation around this like process. But yeah, I hesitate, I don't know how you think about that. If I'm going out fundraising, I can say, hey, look at all my homegrown tooling that I built myself. Look at this great demo. Versus like, yeah, I use this like platform Velvet that everybody else uses. How do you think about that? What
Yeah,
would be
I
more
think it's
impressive as an LP?
yeah.
Like, oh, like Brian built all his own stuff for Team Ignite. That's really cool.
Well, I do think it is starting to get commoditized a little bit, right? And some of this is the stuff that, the internal cycles that we're having on the product side within Revere and Velvet is staying ahead of that innovation curve. So I think the buy versus build, I think, is personal preference. I think the expectation is LPs want to see that there is efficiency in terms of how you're processing data. I think the next iteration is really, and again, you have a very large network, right? If you said Team Ignite, is how do you start to represent and quantify the value of the network? So I think the next phase of who I would classify as, the heuristic of, who's a credible, not only credible, but who are the outliers in the emerging fund category. It's really like quantifying the network, the extended network that they bring to bear, not only on behalf of their portfolio companies, but how you potentially, again, this, right? A lot of your LPs can be value add to your portfolio companies. So I think that's really the next frontier, because that's always been a little bit of a walled garden, right? But if you can start to get connectivity between your GP, your fellow co-investors that you GPs that you co-invest alongside, you got their portfolio company founders, you got your portfolio company founders, and then you've got your LPs and LPs. Now all of a sudden, you have an extended network that anyone who's a member of the Team Ignite platform or community has access to this extended network. That becomes tremendously valuable.
So what are you excited to, in the long term, next 5 or 10 years? And maybe we could start with like, how has venture capital changed? You've been doing this for a long time, been in the game, 15 plus years. What are you seeing in the market today? And then we'll talk about the future after that.
Yeah, it's all distribution today. Or I would say today in the next 5 years, you're now, the opportunity is like, how does venture capital as an asset class find distribution channels into new pockets of capital? Increasingly, that's, the RIA market, private wealth. There's a lot of overseas capital. There's tremendous renewed interest from corporate VCs to invest in venture funds at the early stages. So how can we build pipes and infrastructure to get better distribution? It's really, I would say, two things. Number one is just venture starts to look like a financial product, right? So the same way you might buy an index fund, like there's a venture fund of funds that kind of looks like an index, right? Or a thematic fund of funds. I think that's
That
something
would
that's already
be the
started.
vision. That's exactly the vision for Team Ignite and I might have to do an evergreen fund publicly traded structure at some point, but we basically want to become that index for early stage. And so institutionals kind of go, because there's 30,000 companies a year worldwide that get pre-series A funding. Now, we're not going to buy 30,000 companies. That's ridiculous. Even though there was an AngelList study where you bought, remember this study? You probably were
Yes,
involved
of
with the study.
course, of course.
If you invested in every single AngelList deal, you'd be in the top quartile of VCs
Yeah,
of returns.
yeah,
Yeah, remember the study?
yeah, of
So that's
course.
kind of our vision. I think I'm happy at Team Ignite if I can be in the top, everybody wants to be in the top decile, but if I can be in the top quartile, I'll be able to continuously raise funds forever. And then
Yes.
and then it's mathematically putting our CFA brain into venture capital is like, okay, mathematically, how many do you need to invest in to hit the efficient frontier of the asset class, the risk adjusted return, maximize your chances of I'm sure you've done some pretty deep thinking on that. How do you think about that in the early stage? Because I've written probably a dozen articles on this at this point, and a lot of the studies I cited were AngelList studies and others. And there's different ways of approaching the problem. You can run Monte Carlos, you can use probabilistic reasoning, you can How do you think about that? Like, what's the efficient frontier of early stage venture?
Well, as you go earlier, more shots on goal. And I think it's depending on the study, you're looking at every kind of vintage year, you need at least a few hundred to be able to kind of find enough shots on goal that get you the ability or the probability to hit, the requisite number of outliers to generate
And that's a
two,
few hundred
three
per
X.
year.
Yeah, 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 yeah,
Yeah,
yeah.
that's kind of the
So
vision. That's where we've kind of arrived. We don't have the capital to go do 300 a year, but we will probably fund after next. And so we want to basically scale up to do about 1,000 per fund, which would be about 300 a year over a 3-year deployment period, which is crazy. It's a crazy number of startups.
it's a different construct. So
Yeah.
if you think about, the original thread was like new distribution channels are opening. Those distribution channels are requiring or demanding something that looks like a financial product. And as a financial product, you're trying to deliver consistent returns, right? Consistent sort of
Bingo.
above
Yeah.
median returns. So if you take that sequence, then that means the fundamental strategy that you have to develop. Again, we didn't talk about evergreen structures, which is kind of a conversation
Yeah.
unto itself.
Yeah.
But then the fundamental construct is you do need to find, again, that kind of efficient frontier of enough shots on goal to deliver, let's just call it 2 to 3x returns in a diversified fashion, right? Then you're absolutely in that top quartile conversation. And that's very antithetical to the roots of venture, which is like, hey, I'm going to be a little bit more concentrated. I'm ownership driven. I'm going to, find the next stripe, and that's going to make my career. Now all of a sudden, like, I'm Sequoia or Benchmark. And it's not to say that those two things can't coexist, but they are fundamentally two different types of strategies. And it all comes back to, who are the end, who's the end customer, right? So something that I would say kind of the artistic way of doing venture in the old school fashion. I mean, you're trying to get into endowments and foundations. The new way, right, is distribution to RAs that want a financial product where, a private wealth manager could put 2% of a client into this venture capital index or something that looks like that gives them uncorrelated or non-correlated returns to the rest of the portfolio, but there's some confidence in that this is, kind of better than just simply spraying and praying. So these are all fascinating things
Right.
that are going to happen in the next 5 years, and it's going to just increase the TAM of the venture industry overall.
Right. Yeah. If you have the consistent, predictable returns within normal bounds, and it is uncorrelated, right? Because venture doesn't have the beta that other asset classes do. What is the best structure? Is it the 10-year fund, or do you have to do like some sort of evergreen kind of REIT kind of tradable structure?
Yeah, in the long term, it is evergreen. Now, what is required to unlock the full potential of evergreen structures is a very active secondary market. Because today you can't, even for these late stage unicorn companies, I mean, there's still a pretty wide variation of, bid-ask spread, right? And then valuations are, kind of astronomical now for AI companies. So the key unlock for that evergreen structure just kind of demands enough liquidity or enough of a secondary market to be able to predictably get capital in and out in a fashion that the evergreen structure starts to become more efficient, right? It's never going to be perfect, but I think that's
Right.
really
Because if you have a basket of 1,000 startups and somebody's like sells a big LP sells the entire position, and say your net asset value is $1 billion, I'm just making up numbers. Now you got to liquidate 100 million worth of secondary
right,
to go fulfill that order, right? To
right,
redeem that request. It's a sticky situation because the market is uneven, as we were just talking about before recording, how frothy secondaries are right now. The market is uneven for secondaries depending on basically the brand mystique of that secondary, right? And so you could end up in these like weird situations where, oh, I'm sitting on a bunch of Anthropic and I can sell that and get that redemption fulfilled, but that is not the best thing for all the other LPs remaining in that venture fund, right? Because venture fund is a power law. And so you almost have to do the closed structure, I think, and say, nope, you're kind of in it until the end, and everybody's in the same boat. And maybe that's why it's always been this limited partner tenure
yeah, yeah.
structure.
Nothing's going to flip overnight, but I think where there's a lot of positive signs that now that we do have a pretty active secondary market is even in the 10-year structure for an early stage company, when you do have those breakout winners, generating DPI doesn't have to be completely reliant on an IPO or an
Because I got you now. I'm getting free advice here on the podcast. If you have an opportunity to 1x DPI your fund, you could sell. Let's say you're sitting on a unicorn and you could 2x the entire fund by selling the entire thing, just selling in the next round, just selling the entire holding. Or you could sell like 50% and you 1x DPI, or you just like sell 25% and you 0.5x DPI, or you just kind of let it ride. What do you think is the best thing to do in that situation?
X DPI is a pretty magical number because I think psychologically for LPs, it's all upside after 1x. And now it's not entirely true because again, underwriting ventures like, at least 2, 3, 4x. But psychologically, given how protracted the liquidity cycles are, X is pretty awesome. So I would say start with the optimization of 1x versus 2x. 2x is amazing. It's great. Definitely kind of put you upper decile from just a DPI perspective. But 1x is the psychological mark. So at that point, it's like, hey, look, we've returned capital and now, the rest of the portfolio can continue to ride. And then I can give you some scenario analysis of like, hey, it's going to be no less than another 1x. But, if we ride this out, it's another 5x. I think that logic definitely computes with LPs.
Good advice. Well, let's wrap up with some rapid fire. What's a false assumption about emerging managers or GP investing that you want more LPs to unlearn?
Yeah, this is a good one. I think it's perfectly okay for a GP to have one or two funds and not continue to like go on and be forced to like, oh my gosh, I got to find a second partner, or I need a succession plan if like I'm an older GP. Strategies change, circumstances change, the markets change. I think it's absolutely something from an LP mindset. Like you should be thinking about this as like, I have to invest in the next big franchise. So I think that's something that I would encourage LPs in this category.
What's a signal or metric you've seen in a fund early on that eventually correlated strongly with outperformance?
Helping portfolio companies get that first customer or anything, in that the product market fit category is such a critical milestone, speaking as a founder, right? And I'm coming at this lens not as an LP, as a founder, knowing like, where did I de-risk my business? It's really, finding that true product market fit, which generally coincides with, your first set of, pilots converting to paying customers. So if there's one singular kind of metric that I would encourage both GPs and LPs to look at as a key indicator, would be that.
What's a fund you admire, small, underrated, doing something interesting, and why? Besides Team Ignite, of course.
Of course. Yeah, I go way back with CC at Boom Capital. Boom Capital is a deep tech, very scientific oriented fund. It's always been kind of very modest size, less than $50 million. And so I've had the benefit of following CC's journey since, even before she started the fund. But what I admire about it is it's non-consensus, right? They were talking about like brain tech before people were even like fathoming like, what does brain tech mean? They were talking about AI, and they were working with researchers and putting together peer groups of like, how do researchers with these amazing white papers, how do they commercialize it? So definitely admire and respect CC for staying true to what the ethos was of the original Boom Capital, and then also doubling down on sort of like the network and the community. She's been amazing in terms of, and even engaging her LPs, right? She invites her LPs to all these events and all these like thought leadership seminars and stuff with like key researchers. So the level of access has been amazing. So that's just one example, of course, and I've got a whole bunch more, but I know this is rapid fire.
Let's take the inverse. What's an investment or fund decision you regret or wish you did differently, and what lesson came from it? And you don't have to name names, obviously, but you can speak in generality.
I think I would put it in two buckets. One bucket is where where there are kind of partner, like if there's two or three partners, where there is some partner dynamic you maybe couldn't pinpoint at the time, where it's like, you know what, it just doesn't feel harmonious, right? Or maybe it was a shotgun wedding of two partners who spun out of different firms and they came together and on paper it looked amazing. But then when they actually got into the job function of working together, like things didn't work out. So that's always one. And I've had a couple examples, but that's one. The other one is, I think companies that tried to, I call kind of, if we think about Andreessen, right? The platform of Andreessen, of sort of hiring a bunch of people to extend the capabilities of how they can add value to their portfolio companies. I think you can take that to a fault, because if you say this on a pitch deck and you actually don't deliver, which this is the example that I'm thinking of, then it looks really bad. And at that point, it's just like you're on the blacklist. Like you said, you're going to do all this stuff. You had all the facade of the platform and you never delivered, right? That's basically a kiss of death.
Yeah, I love that. How do you personally at Revere guard against rating capture or in-group bias inside your team?
We always run an investment committee. So the entire team of analysts and people who are kind of looking at fund managers. And again, it's not just like, I'd say senior people like myself and my co-founder, Chris. We have people who are like out of school and they just started doing the rating process and trained up on it. And they bring kind of all sorts of curiosity and kind of innocent questions, but those questions are informative. So I think the committee process is still one that's both authentic, genuine, and important in terms of the decision making, again, for ratings, but even beyond that.
Well, I could talk to you for another hour. I was trying to cut it short just to stay within time. Where can folks find you online and find out more about Revere?
Yeah, LinkedIn is the best place to hit me up. The preview here is, Revere and Velvet coming together. Check us out.
Yeah, congratulations.
Yeah, appreciate it.
And we'll
Velvet.vc
definitely
is,
have this episode out after you announce that, and I'll make sure of it. But any kind of takeaways on that kind of 5 or 6 year journey of being a founder, now being in a larger company, becoming like, yeah, any final takeaways on that?
yeah, I think now that I've kind of worn all the hats, GPLP and founder, I have even more conviction on building stuff, right? So I think the ethos here, as a GP investing in very early stage companies, you're investing in builders. I'm building this, like there's no better place to be. And then the second part of that is capital is increasingly becoming global. So I've spent a fair amount of time in Asia doing fundraising when I was at Top Tier. I spent a lot of time getting customers, right? So half of Revere's customers are actually based in Asia. But that's the other thing I would say in terms of next frontiers, global access to global capital is going to become a really important component to the venture capital industry. So really excited about that as well.
Yeah, so cool. Well, I can't wait to watch your progress over the coming years.
Appreciate it. Thanks for having me on, Brian. This was an amazing
Yeah.
conversation.
Yeah, likewise. Thanks for coming.